Bitcoin just reclaimed 78,000. Fear is easing, and momentum looks like it's returning. But at the same time, over $500 million has been lost to exploits. Funds are being frozen mid-transaction, and deeper structural risks are starting to emerge. So the real question is this strength real, or are we in the kind of market where risk builds quietly before it shows up in price? This is not financial advice. This content is for informational and educational purposes only. Always do your own research before making any investment decisions. Welcome back to Ledger Pulse. If you want to understand what's actually happening beneath the surface of crypto, not just price, but structure, risk, and behavior, make sure you're subscribed. Because right now, the market is telling two completely different stories, and the gap between them is where things get interesting. Let's start with the obvious one, price. Bitcoin reclaiming 78,000 is a meaningful move. It suggests buyers are stepping back in, key levels are being defended, and short-term momentum is shifting. But here's the problem with focusing only on price. It's reactive. Price will tell you what has already happened. It doesn't tell you what's building, and markets are forward-looking. So while price looks strong, we have to ask, what is this strength built on, and how stable is it? Because not all rallies are equal. Some are built on expansion, others are built on imbalance. Even after this move, the fear and greed index is still sitting in fear territory. This is one of the most important signals in the market right now, because it shows people don't fully trust this move. And that creates two possible interpretations. The bullish interpretation. Market climbs while people are underexposed, and upside is fueled by hesitation. The bearish interpretation. Market is rising without conviction, and underlying uncertainty remains unresolved. And here's the key. Both can be true at the same time, which means this environment is opportunistic but unstable. Under the surface, risk is accelerating. DeFi exploit losses have now exceeded 600 million in a single month, with one of the largest events, the Kelp DAO exploit. At some point, we have to stop calling this noise, because numbers like this indicate a structural issue, not isolated incidents. If this were happening in traditional finance, it would trigger regulatory responses immediately. In crypto, it's being absorbed into the cycle, and that normalization is both impressive and concerning. Over 30,000 ETH was frozen on Arbitrum. Funds stopped, locked, and intervened. This is where things get uncomfortable, because crypto is built on the idea of decentralization, permissionless systems, and censorship resistance. But when funds can be frozen, we have to ask, who has that authority? Under what conditions? And how decentralized is that system really? Now to be clear, freezing funds in response to exploits can be justified. It protects users, it limits damage, but it also reveals something important. There are centralized control points in the system, and that creates a paradox. The same mechanisms that protect users also challenge the core philosophy of decentralization. This doesn't mean decentralization is failing, but it does mean we're operating in a hybrid system, where some layers are decentralized, some layers are controlled, and most users don't fully understand the difference. This is starting to look systemic. Across multiple incidents, more than 500 million has been siphoned in a short time, and there are signs of coordination, possibly even state-linked activity. This is where risk shifts from technical to strategic, because coordinated attacks suggest target selection, timing, and pattern recognition. And that means the system isn't just being tested randomly, it's being studied. The real weakness isn't in the blockchain. These exploits did not break cryptography. They didn't hack the core protocol. They targeted bridges, cross-chain messaging, and verification layers. This is critical to understand, because it means the base layer is secure, but the layers built on top, the one users rely on, are still maturing, and complexity is the enemy of security. The more interconnected the system becomes, the more potential points of failure exist. Projects are adapting, but that tells a story. Some protocols are now freezing funds quickly, absorbing losses, and improving response times. This is progress, but it also signals a shift. Exploits are no longer rare disruptions, they're becoming expected events, and when something becomes expected, it changes how markets price risk. This starts to impact adoption. There are already concerns that events like this could slow tokenization, delay institutional entry, and increase due diligence requirements. Institutions don't just look at upside, they look at risk-adjusted return, and when systemic risk increases, capital becomes more selective, which doesn't stop growth, but it slows it. AI-driven systems are now being deployed, trained on millions of investigations, and designed to track and prevent crypto crime. This is the natural response, and it creates a dynamic where attackers improve and defenders improve. But here's the key. This process takes time, and during that time, volatility increases. Now, let's zoom out even further. Quantum computing is starting to enter the conversation. Some analysis suggests certain networks may be more exposed over time. But here's where things get interesting. There are also networks actively preparing for this future. For example, XRP is often cited as having significantly lower exposure with only a small percentage of wallets potentially vulnerable under quantum scenarios. Cardano has also taken a research-driven approach, with a strong emphasis on formal methods and forward-looking cryptographic resilience. Now, it's important to stay grounded here. Quantum risk is not an immediate threat, but markets don't wait for threats to arrive. They anticipate them. And what this introduces is a new layer of competition, not just speed or cost, but long-term security design, which means narratives may begin to shift toward future-proofing, resilience, and security at scale. And that could influence how capital allocates over time. Some networks may be more exposed than others. Some are already preparing, others are not. This isn't an immediate threat, but markets don't wait for certainty. They price probability, risk, future scenarios, and even the discussion of quantum vulnerability adds another layer to how assets are evaluated. So now step back. We have price moving higher, sentiment still cautious, exploits increasing, funds being frozen, infrastructure weakness exposed, adoption questions emerging, defense systems evolving, and future risks entering the conversation. This creates two realities: a market that looks strong and a system that's being stress tested, and both are true at the same time. So, is this a recovery? Yes, but it's not a simple one, because underneath that recovery, risk is rising, complexity is increasing, and the system is evolving in real time. If you want to stay ahead of both the opportunity and the risk, make sure you're subscribed, because in this market, the biggest edge comes from seeing both sides at once. If you found value in this breakdown, hit the like button and let me know your thoughts below. Thanks for listening. We'll catch you on the next one.